Brilliant Bank operates as an online-focused banking division providing digital financial products designed to offer competitive returns compared to traditional brick-and-mortar institutions. Evaluating how financial institutions handle their annual percentage yields requires looking closely at the structure of variable rate accounts versus fixed-rate products. Financial markets experience constant shifts driven by federal funds rate decisions, inflation data, and broader economic cycles. Understanding these mechanisms clarifies how online banks manage customer yields over time. Variable rate deposit accounts, such as money market accounts, feature yields that are explicitly tied to prevailing market conditions. When central banks adjust benchmark interest rates upward or downward, financial institutions offering variable products typically review their internal pricing models. If economic indicators shift or competitors reprice their deposit offerings, banks like Brilliant Bank retain the discretion to alter the annual percentage yield on variable accounts to align with market realities. This means depositors holding variable rate funds should expect their earnings to fluctuate dynamically alongside broader economic shifts. Fixed-rate products operate under a completely different framework. Financial instruments like certificates of deposit lock in a specific annual percentage yield for a predetermined term, regardless of how market conditions evolve after the account is opened. Once a depositor secures a fixed term, that exact rate remains protected until the maturity date is reached. This distinction provides predictable returns for savers who want to shield a portion of their capital from potential downward movements in the wider financial market. The operational cost structure of digital-only banking models also influences how rates are managed. Because online institutions avoid the overhead expenses associated with maintaining physical branch networks, they frequently pass those savings on to depositors in the form of higher yields. However, they remain subject to the same macroeconomic pressures as any other financial entity. Maintaining competitiveness requires a delicate balance between attracting new deposits and managing institutional profitability. When market rates decline across the financial sector, variable yields often follow downward trends to prevent the institution from paying unsustainable interest expenses. Monitoring the movement of yields on accounts like the surge money market requires staying informed about macroeconomic announcements and Federal Reserve policy meetings. Savers evaluating where to allocate funds must weigh the flexibility of variable products against the security of fixed-term options. Reviewing the specific terms and disclosure agreements associated with digital banking products ensures a clear understanding of how rate adjustments are communicated and implemented.